So what is planning? When we say planning and audit, what do you think we're talking about? Any ideas? Planning and audit, what do you think we're talking about?
Thinking through and stating how the audit procedures will be carried out.
Okay, thinking through and finding out how the audit procedures will be carried out. So you find out, what do I do first, what do I do second, what do I do third, to make sure I issue what? An auditor's report. Okay, so we put it down to say that planning and audit involves establishing the overall audit strategy. Planning and audit involves establishing the overall audit strategy. Establishing the overall audit strategy for the engagement. Establishing the overall audit strategy for the engagement and developing an audit plan. And developing an audit plan. And developing an audit plan. So off the bat, from that definition, we realize that audit planning entails two things: establishing the audit strategy and then the audit plan itself. Now, what is the difference between a strategy and a plan? What's the difference between a strategy and a plan? What would you say are the differences between strategy and plan? Strategy and plan, are they the same?
No.
Okay, so what do you think? Come on, give a shot.
Strategy is more detailed than a plan.
Strategy is more detailed than a plan. Okay. Okay. So, what is a plan? Let's say you plan to have, or your plan is to have $100,000 at the end of the year. That's a plan. So, how is that going to be achieved? Can you give me an example of how it's going to be achieved? Maybe your salary. Maybe you have to reduce some expenditures. Maybe you have to stop going out so that you don't spend much money. Are you getting there? Now, in a simple language, audit plan is the detailed procedure of the audit. The detailed procedure of the audit. Whilst the audit strategy has to do with how the procedures will be undertaken. You get the idea? So the audit plan is the detailed procedure. So how do we undertake the audit? That is the audit plan. The detailed procedure we will use in the audit. Whilst the audit strategy has to do with how you are going to undertake the audit. Now, what is the distinction here? What is the distinction here? Maybe you identify that when you are doing your audit, you will review the internal controls. After reviewing the internal controls, you will test the controls. Now, the review of the internal controls is for you to understand them. After understanding, you will test the controls. If you test the controls and they are effective, then you will do what we call the selective substantive procedures. Selective substantive procedures. But if they are ineffective, then you will undertake what is called the full substantive procedure. Look at it carefully. The audit plan is this thing, like how you want to undertake the thing. That is the audit plan, the detailed procedure. The audit strategy has to do with what you are finding. Whether you should go for a selective substantive procedure, or you should go for what? The full substantive procedure. That is the audit strategy. But the big question we ask ourselves is, why do we need to plan? Why do you think it's important for us to plan our audit? So reasons for audit plan. Why? Why do you think we should plan? What does it do to the auditor?
It helps the auditor to assess his performance and see if he's on track.
Okay.
Of what he intended to do.
All right. So what you are saying here is that it helps or it facilitates the auditor to effectively undertake his audit. So that if we have a plan of what we are supposed to do, then as at now, what are we doing? So we find out whether we are doing what we are supposed to do. What else? What else? Don't you think during planning, the auditor will be able to assess the risky areas of the audit? Will you agree with that?
Yes.
It will be able to look at the risky areas of the audit, which requires more attention. Because as I said earlier, the truth of the matter is that we won't do 100% of the work. So we must identify if we are going to do 20% of the work, which is the risk-based audit. We will look at this later on. If it is a risk-based audit, then the 20% that is risky, that is where we are going to focus more attention. So it helps the auditor to identify those risky areas. What else does it do? You think? How about resources?
Yes.
When you plan the audit, by understanding the client entity, you will look at the experts you need. You will look at how long if something is going to take you, about that. Then you will look at also the issue about the number of people you need. So the experts has to do with the skill set you need, and the number has to do with how many of them do you need. So that is also another key aspect of our planning. So these are some important that we can talk about. If we want to put the points down, maybe let's put some 3 or 4 points down. So number 1, reasons for planning. Number 1, helps the auditor to devote appropriate attention. Helps the auditor to devote appropriate attention. Helps the auditor to devote appropriate attention to important areas of the audit. To important areas of the audit. Next one. It helps the auditor to identify and resolve. Helps the auditor to identify and resolve potential problems on a timely basis. Helps the auditor to identify and resolve potential problems on a timely basis. Potential problems on a timely basis. Next one. It helps the auditor in the selection of engagement team members. In selection of engagement team members. Help the auditor in selection of the engagement team members. Then the last one I would add is help the auditor to properly organize and manage the audit engagement. Help the auditor to properly organize and manage the audit engagement. So these are some important reasons why we need to plan.
But a question. Before the plan is done, before the auditing is done.
That's right.
But it seems to me that there are some things in the planning that you would need to start the audit before you can get a clear view of.
Yeah, you see, at the planning stage of the audit, definitely you visit the client entity. So if you remember what we did under the GAS, Generally Accepted Auditing Standard, I said, general tip, take a field peek. So here you are in the company, you visited the company. So definitely, yes, you have started the work though. Are you getting it? Because part of the planning, you must understand the internal controls of the company. So yes, you are visiting the company and you are literally working. But the evidence you are gathering on that stage is for you to understand how things work in the company. Not really into invoices, purchases order, trade receivables, trade payables. I hope you're getting it. Right. So let's look at, we said there are two things here. So let's start with the audit strategy and look at what the audit strategy talks about. So we said the audit strategy has to do with the approach that we are going to be taking for the audit. So let's look at the audit strategy. The audit strategy. So we said that the audit strategy relates to the overall approach that we will take in the audit. The overall approach that we will take in the audit. Now, it entails a lot of things. One, it looks at the scope of the audit. So, audit scope. Now, when we say the scope of something, what do we mean?
The area is covered.
The area is covered. The area is covered. So, the audit scope simply refers to the time and document involved in what? The audit. Are you getting it? The time and document. In other words, the audit scope answers the question, how much work are we going to do? How much work to be done? So that is the scope of the audit. It covers the amount of time and documents which are involved in the audit. The amount of time and documents which are involved in the audit. Not only that, in addition to scope, we need to talk about timing. Timing. Now, timing here entails when to start the audit, when to end the audit, and when to communicate with those charged with governance, and when to even visit the client's entity. Because you cannot just go there by heart. You must inform them prior to your visit that these days I will be coming, so you don't interfere with the day-to-day running of the company. Remember, the business is still in operation, so you cannot be there to interact with their day-to-day activities. So timing has to do with when we are starting the audit, when we are ending the audit, when are we going to be communicating with those charged with governance. Again, you cannot just get up and say, we are the auditors, so tomorrow we want to meet the management of the company. You don't do that. You must set the time at the start of the audit when you are going to what? Meet the management. Because chances are they are going to a meeting somewhere. Chances are they are traveling somewhere for a business decisions. So the fact that you are an auditor does not warrant you the right to talk to management anytime you like, or those type of governance anytime you like. It has to be pre-scheduled so that they know that these days and these days you are going to be coming to them to audit. Then, not only about how much work we need, the time and the documents involved, and the timing, but the third thing has to do with the direction of the audit. The direction of the audit. The direction of the audit simply refers to how the auditor is going to undertake the audit. How the auditor is going to undertake the audit. How the auditor is going to undertake the audit. Now, how the auditor is going to undertake the audit depends on two things. So the direction of the audit depends on two things. So this depends on, first, understanding the client entity, understanding the client's entity, and then the materiality level. Understanding the client's entity and the materiality level. So let's take the first one, understanding the client's entity. What do we need to understand about the client's entity? Understanding the client's entity. So what is it that we need to understand about the client's entity? Now, according to ISA 315, that is assessing the risks of material misstatements. Assessing the risks of material misstatements by understanding the client's entity. So according to ISA 350, assessing the risks of material misstatement by understanding the client's entity, there are things we need to understand about the client. What are these things? The first one is the internal control systems. And I've spoken about internal controls already, so I'm not going to be talking much about it here. How are things done within what? The organization. So we need to look at that as auditors. Are they doing things the way they are supposed to do? Do they prepare bank reconciliation statements on periodic basis? Are they reviewing their internal control system? How do they authorize processes in the organization? How do they approve purchases in the organization? We need to understand the internal control systems. Not only that, we also have to understand any external factors facing the organization. External factors. Now, external factors refers to the factors within the environment of the company. In other words, the external factors include what is the level of competition in the industry that a company is in. Because this is what you have to understand. If the company is located in a highly competitive industry, then it could mean that, and the company doesn't have enough market share, then probably management may try to overstate the revenue of the company or understate the expenses so that the profit will be what? Big. So we must understand what? The competitive environment of the company. What is the level of competition and what is the market share of the company? Because that will affect how the financial statements are presented. MTN prides that, or pride in that, December or for the last year ended, they made billions of Ghana cedis, a huge amount of money. It's a competitive environment, so Airtel Tigo will also come and say, okay, we also made a profit like this, and you could see they are all declaring. Then Glow, who doesn't have much market share in Ghana, will management of Glow, do you think when they are preparing financial statement they will say they made a loss? No, it will surprise you that they will declare a huge profit and you'll be like, where are you making this money from? Are you getting it? So the level of competition will affect how financial statements are presented. And we have to understand as auditors the competitive environment of the company as well as its position in the environment. Does it have a large market share? We understand MTN's profit because it has about 50% of the population. We understand Airtel Tigo because it also has some influence. We understand Vodafone to some extent, it has some influence. But Glow, if we are auditing them, we will have to take into consideration the level of competition and their position in Ghana, to be specific. Another thing we can talk about the external factors is about laws and regulations. Laws and regulations. What are the laws that guide this entity we are talking about? What are the regulations that guide them? Are there any changes in those laws? So that, for instance, if it is a bank, like I mentioned earlier, and now the minimum capital requirement has been increased by the Bank of Ghana, and the bank realizes that they can't meet the minimum capital requirement, they may try to prepare fictitious financial statement so that their profit will be presented high, their balance sheet will be presented high, and that will mean that the financial statement may contain a lot of what? Errors and misstatements. That is why we must understand the laws and the regulations that governs the organization. But not only that, in addition to that, we have to look at the various disclosures and provisions that they have made. Various disclosures and provisions that have been made in the financial statement. Why is this important? This is important because if there are environmental factors, for instance, it's a mining company, and the company is supposed to repair the environment or restore the environment to how it was, then they must disclose that and make provisions for that in the financial statement. But look at it. If they are cleaning up the environment, they are providing for the cleanup, that means expenses will increase for the year, which means profit will be what? Reduced. So we have to find out, are there any of these external factors that may affect the entity? We must identify that. We must identify that. So we have to understand these three external factors and find out how they can affect the entity, because remember, at the end of the day, we are assessing the risks of what? Material misstatement. So how are the internal controls? What are the external factors? Third, understanding company structure and accounting policies. Understanding company structure and accounting policies. Understanding the company structure and the accounting policies. Now, when we talk about structure here, it has to do with a lot of things. So, what kind of markets is the company in? How many divisions or branches does the company have? What are the effects of the accounting policies in all those markets or those divisions? For instance, if the company is located in Europe, so they have a subsidiary in Europe, they have a subsidiary in Africa, parts of Africa, they have a subsidiary in part of Asia, then their structure is going to be different. And so when we are auditing them, we are the principal auditors, because we are auditing the group of financial statements, then we have to be careful the way we approach the organization. So understanding the structure, how many branches do they have? How many divisions do they have? Maybe they have just one office in East Lagos. Then it's easy for us. Maybe they have three branches, one in Takoradi, one in Kumasi, and one in Accra. It will be much easier. Maybe they have 100 branches across the country. Are we going to visit all of those branches? That is what we mean by what? The structure. Because the way the organization is structured will affect the kind of accounting policies in place. Exclusively, all companies in Europe, Africa, and Asia will prepare their financial statement according to the generally accepted accounting principles, which is the GAAP, which follows the IFRSs or maybe IASs. But the national laws in those countries will be what? Different. Hence, as auditors, when we are auditing the group financial statement, we must take into consideration all of these factors in auditing the company. That is the third thing we must understand, the firm's structure. 4. The fourth thing is company's performance measurement. Company's performance measurement. Company's performance measurement. Now, this simply has to do with how the company assesses the performance of the management of the company and pay them bonuses as required. Now, there are various performance assessments. It could be profit growth. It could be increase in share prices. It could be increase in market share. All of these can be performance indicators that companies can use. Now, if management is going to be paid based on profits, then it is likely that management may be involved in something so that the profit figure will be big. So if they say, for instance, last year profit was $200 million. If you are able to make this profit grow 40%, you will take 50% of it. What does it mean? So 40% of this is going to be what? 80 million. Is it 80 million? Yeah. So meaning if current year profit is 80 million, what is the extra? 80 million. You are going to take 50%. So you have 40 million to chop. The question is, do you think management will be engaged in some fictitious activities to achieve this goal so they can take the 40 million home? Do you think they can engage in that? They can do something? Okay, so the company's performance measurement is based on profits. Then let's say that last year they made a profit of what? 200 million. And shareholders agree that if you are able to increase profit by 40% this year, okay, 50% of that increase will be paid to you as bonus. And I'm saying that 40% of that is what? 80 million. Hence, now the profit should be what? 280. And I'm saying that if you make this extra 80, shareholders are saying that we will pay 50% to you as what? Bonus. My question then is, do you think management, even if the financial statement doesn't reach or the profit doesn't reach this, will try to manipulate to reach that?
Yes.
It's possible. So we have to identify how are management performance evaluated. That's the fourth thing we need to understand about the client's entity. Then number 5, the company strategy, business plan, and related business risks. Company strategy, business plan, and related business risk. Company strategy, business plan, and related business strategy. What does it mean? It means that we must understand the strategy of the company. It means the long-term goals of the company. Are they planning to do some acquisitions? Are they planning to open some new branches or new locations? What are the risks associated with the long-term goals of the company? All of these things will have to be taken into consideration. For instance, let's say a company launched a new product and the product became a failure, meaning the product didn't do well. What do you think will be the effect of that on the current year financial statements? The company launched a product and the product failed. What do you think will be the effect of that on the current year financial statements?
To reduce profit.
It will reduce profit because meaning that the company is going to be incurring what? More cost. Now, if the product failed and that will reduce profits, and management always wants to appear to the shareholders that they did a good job, what do you think they are likely to do? They are likely to what? Cook up the financial statement, omit certain costs and other things. So we as auditors, when we come, we have to find out, did anything like that occur? What is the long-term strategies of the company? What are the related business risks for the company? Then we can factor in and find out with our professional skepticism mentality, find out whether something is likely to go wrong in the what? Financial statement. These are the 5 things we need to understand when assessing the risk of material misstatement. Any question? Any question? All right. Now to you, I have a question. How can the auditor assess the risks of material misstatement by understanding the client entity? How can the auditor assess the risk of material misstatement by understanding the client's entity? What do you think? How do we know about the structure of the company? How do we know about the accounting policies? How do we know how performance are measured? How do we know how the internal controls are looked at? How do we know the external factors the company is facing? How do we know the company structure, business related? How do we know these? Do you have any idea?
You mentioned that they visit the entity
Yeah.
to assess how things are done.
Okay, that's true. So, meaning that in understanding, assessing the risk of material misstatement, the auditor performs what? Some audit procedures. The auditor performs some audit procedures. So, auditors undertake audit procedures in assessing the risk of material misstatement by what? Understanding the client entity. But the question is, what are these procedures that they carry out when they get to the client entity? Number one is called the analytical procedures. Analytical procedures. Now, what are analytical procedures? Usually, analytical procedures simply has to do with...
Are we done with the strategy?
No. All this is on the strategy. All this is on the strategy. So analytical procedures simply refers to the comparison of current year results with budgets, previous year, or industry information. So analytical procedures has to do with the comparison of current year results with budgets of previous year or industry average. That is the analytical procedure. So we're going to be calculating the ratios of the company. It's part of it. We're going to be looking at it. So if we look at the current year financial statements and compare the previous year and compare what was in the budget and compare what is happening in the industry, what is happening. So let's see. Let's say sales current year is 200 million. Sales in the previous year, so this is current year, this is previous year, this is in the budget, this is in the industry average. So current year our sales is 200 million. Last year our sales was say 120 million. In the budget the sales figure was $175 million. The industry average for sales for that company is say $201 million. What does this inform you as an auditor? What will you say? Current year, previous year, the budget, industry average. Can this thing tell you something? You can't tell you anything. Wouldn't you ask any question about this? Why is it that in your budget it was 175, but currently it is 200 million? Why is it that last year you had 120 million and this year you had 200 million? Like, what prompted that you exceeded your budget by a whooping $25 million? Like, what would you ask any question like that? You need to ask. So analytical procedures has to do with what? This comparison. So the whole industry is 201 million on the average. You are 200 million. That means there is something you did. So that is the first step. That is the first step. We do this comparison for these assertions that a company is making. Now, we will be getting into audit procedures later, but we have indirectly started. This is an assertion. Assertion is simply all the figures on the financial statement are assertions. So the sales figure is an assertion. It's a statement that management is making. The cost of sales is a figure, is an assertion, is a statement that we'll be making. So we will test for the major assertions by comparing the current results with the previous year, with the budget, and with what? The industry average. To find out what is happening. So per the trend, per the changing, we can conclude and ask management. What happened? Then maybe management could tell us that the reason why we have exceeded our budget is that we won a contract which we were not expecting to win. Or the reason was that a company or a church was doing an event and they came to buy some of our products which we didn't factor in when we were preparing what? Our budget. So now we understand to some extent why there has been what? This increase. That is what we refer to as analytical procedures. Second thing is that when we undertake these analytical procedures, we go to the second step, and that is called inquiry. Inquiry from management. We need to inquire. Remember the question we are answering here. We are answering the question, how can the auditor assess the risk of material misstatement by understanding the client's entity? So the way you assess the risk of material misstatement by understanding the client's entity is one, for you to perform analytical procedure by comparing current year results with previous year results, with the budget, and with industry average. When you are done with that, you are going to have a lot of information based on your professional skepticism, questioning mindset, and critical analysis of the evidence you've obtained. So you need to inquire from what? Management. Because the structure of the company, you may read it in the dailies, you may read it in the news, but the strategy of the company, the fifth thing we listed here, you must ask what? Management. Performance measurement, you must ask management. So inquire from management. What are the internal controls in your business? Inquire from management. How are performance measured here? Inquire from management. How many branches or divisions you have? What are the accounting policies you are using? That is what we mean by what? Inquiry from management. But not only that, because there is also what we call inspection. Inspection. Inspection here meaning that inspecting some specific documents. Now, this is one thing you must understand. The audit procedure will be carried out throughout the audit. We are at the planning stage, but we are doing procedures. When we start auditing itself too, we will do the procedures. So inspection. So maybe there are some specific documents we need to what? Inspect. So for the internal controls, the organization will give you their internal control framework handbook. That is, if they have one. So they will give you the internal control framework handbook. So when they give you that internal control framework handbook, the handbook lists out how the entity says they are doing things in the organization. So when you read the handbook, inspect the handbook, then you will go and find out whether what is in the book is what has been put down by the organization, what is working by the organization. When it comes to external factors, possibly we will have to look at what? Various disclosures, management reports, directors reports, management minutes. We have to look at the various contracts that the company has signed. So we must inspect all of those documents so that we have an understanding of the client's entity. But not only that, so AEI, observation. Observation. Observing a process. So we are in the company. We are trying to understand how things are done in the company. Hence, we need to what? Observe the process. So for instance, if you go and you read from their internal control manual and they said that, oh, you see, when you come to our sales department, there are a lot of people who work there. Somebody receives the orders, then the orders received will be sent to another person who processes the orders. Then when that person processes the audit, he will now send it to the accounts department. And after that, the account department will send it to the store department. Then after the store department issues it, the receipt comes back to the person who received the order. This is what they said they will have in their internal control handbook. Observation means go and see whether this is what actually in place. Now this is called segregation of duty or segregation of authority. So there is this segregation of duty. That is what they said they are doing. But you have to go and observe, is that what is in place? So if you go and this is not what is in place, what impression do you make? What impression will you make if you go and this is not what is in place?
There are some fraudulent activities.
There could be some fraudulent activities. Because you go and because you see, this is the truth you must also understand. The truth is that in their handbook they can write that 4 different people do this work. But does it mean we should pay 4 people when 2 people can do this work? So they can employ 2 people. Now these 2 people can what? Connive and embezzle what? Some funds. Now even though 4, they can still do, but the number the higher the number, the difficult it is for people to what? Actually come to one understanding. Because someone will rebel here. But if they are only 2 and they are all greedy bastards there, then they will chop some money there. So that is what you have to understand about observation. You go to the company and observe a process, how they say things are done within the company. Because this will tell you whether internal control systems are effective or they are ineffective. But not only observation, sometimes we need to undertake the last one, which is called recalculation or reperformance. Recalculation or reperformance. Recalculation or reperformance. Now, this has to do with looking at the financial statements before you, like punching it out. Okay, so sales is 200 million minus cost of sales. Gross profit, is that the figure they were supposed to have? The tax they brought in the income statement, is that the correct tax figure? We calculate it ourselves. The depreciation figure, is that the figure they are supposed to bring? They make some provision for depreciation, some provision for environmental costs, some provision for bad debts. Is that the amount they are supposed to bring? That is what we refer to as what? Recalculation and reperformance. These audit procedures are mnemonically represented as the A, E, I, O, U. So anytime you hear about audit procedures, these vowel sounds must come into your mind, and these are what we do in understanding the client entity. So the question was, how can an auditor assess the risks of material misstatement by understanding the client entity? And the answer is, the auditor performs audit procedures. What are the audit procedures? Analytical procedures, inquiry from management, inspection of specific documents, observation of a process in an organization, and then recalculation and re-performance. That is what you have to understand in relation to that.
What is a U?
The U is in the calculation. Calcu. This one. The U is in that one. So normally we write it as capital U. Normally we write it as capital U. Okay. Now, we said that once we understand the client entity, we will be able to assess the risks of material misstatement. So let's look at the next item, and that is materiality level. Materiality level.
Still on the strategy.
Yes. What was the number we got on this?
3.
3. And the 3, I told you the first one was understanding the client entity.
Yes.
And the second one is materiality level. So that is what we want to look at. Materiality level. Now, when we say something is material, what does it mean? When we say something is material, what does it mean? No, don't take me to audit or accounting. Take me to audit or accounting. When we say an information is material, what does it mean?
It has enough evidence.
Okay, it has enough evidence, or it can influence the decision of decision makers. Are you getting it? It can influence the decision of decision makers. So, because for instance, if you are going to a bank to save in the bank, and you've heard that the Bank of Ghana came out to say these banks have not met the minimum capital requirement, so they are no more legitimate banks. Will you go and save in that bank?
No.
Why? Because by the bank they are operating.
Because of the information.
Because of the information. So meaning that information becomes what? Material to you, because it influences your decision. In audit also, the auditor must set what refers to as what? The materiality level. So we say that a misstatement or omission is material. A misstatement or omission is material. A misstatement or omission is material if individually or in aggregate. If individually or in aggregate. If individually or in aggregate, it would reasonably be expected to influence. It would reasonably be expected to influence. It would reasonably be expected to influence the economic decisions of users of the financial statement. It will influence the economic decisions of users of the financial statements. Then we say that the information is material. So a misstatement or omission can be considered or is material if individually or in aggregate it will reasonably be expected to influence the economic decisions of users of what? The financial statements. Very important. One thing you must understand is that when we talk about materiality, it is not only about the amount involved, but also the nature of the transaction. So it is not the value or the size or the amount involved, but also what? The nature. One thing that comes up in this discussion about size and amount is in relation to what we call related party. Now, if for instance, you have a real estate and our company is going to rent a house for our employees, then usually, so Premium Hub and then Erica Properties, so we are coming to lease from you. Then you usually lease out the building for say $5,000 per year. But you said because of our relationship, because you know Nhyira, you are leasing out the building for us at a price of say $3,500 per annum. I think I asked this question in the airfront class. The question is, how should we as a company account for this transaction in our book? What do we do? You usually lease it out to $5,000 to people, but because of our relationship, you lease it out to us at $3,500. How should we account for this in the financial statement?
You state the 3,000.
You state at $3,500. That's all.
and you indicate the relationship that caused the reduction in the price.
In the price. So meaning that if you look at this thing, we are not only talking about what? The value. So yes, we are going to record that we leased the property for 3,500, but the nature of our relationship has to be what? Disclosed in the notes. So if you're an auditor and you go to the company and you realize that something like this happened, so the auditors of Premium Hub comes and they realize that we leased a property from Erica, and Erica Properties leases it to people at 5,000, but they gave it to us at 3,500. But we've not disclosed in our notes that it is a related party, and so this is a related party transaction. Then there is what? An issue here, and that thing is what? Material. Now, what management can do is to record 5,000 and take the difference 1,005 as their own. So we as auditors, when we come, we are not only looking at the the value involved, but also what? The nature of the transaction. Second example. Let's say now Premium Hub goes to audit Erica property. And we didn't charge you any money. It was free of charge. In your books, what are you supposed to do? Do you have to record anything in your book? We come to audit your company and we don't charge you anything because of the relationship. After all, you're also giving us rent that is below the price. So we do free audit for you. What do you think you have to do in your books?
You have to state that the audit was free.
Was free. So you have to disclose it in your book. So there is no value here, but the nature of our relationship means that there has to be what? A disclosure in the notes. This is what you have to understand when it comes to the materiality of the audit. Now, when we understand the client's entity, we must set the materiality level for our audit. We must set the materiality level. The standard says that the materiality can be in two ways. We have what we call preliminary materiality and then performance materiality. Preliminary materiality and then performance materiality. Preliminary materiality and then performance materiality.
Those are the types.
Yes. We don't call them types, but then we call two ways that the materiality level can be set. Okay, ways that the materiality level can be set. Now, the preliminary materiality is the level of materiality that is set by the auditor for the whole audit. For the whole audit. So at the planning stage of the audit, the auditor may set the materiality level for the audit. So the preliminary is for the materiality level set at the planning stage of the audit for the whole financial statement. At the planning stage of the audit for the whole of the financial statement. So, as I said, he will set materiality level based on the nature in accordance with IAS 24 related party transaction, and then he will set also for the amount involved.
It's for the whole.
For the whole financial statement. For the whole financial statement. Now, there are, you have an audit book, right?
Yeah.
Okay, did you bring it?
Yes.
Okay, so maybe let me just refer to those figures there for you for the amounts. Because you are not supposed to really do that in audit and assurance, but just something for you to know about.